Hello, fellow traders. 'Tis I, TheRumpledOne. Tuesday, January the 15th, the year 2019. Let's talk trading. Indicator fads. I received an email from one of the other people who, I guess, send out trading content on a regular recurring basis. And they were talking about indicator fads and how traders, need to be aware about getting caught up in indicator fads, which I agree with. And then they went on to talk about squiggly line indicators, which, I have a small problem with because, we can't all agree on them. They're a concept. They use price as an input and they output something else that is debatable. And the other thing is they never ever run frequency distributions to show, you know, um, where these values fall. They'll do things like back test, but you know how well back tests work. It doesn't. If back tests work, then a lot more people, traders would be winners than losers. That just goes without saying. So just beware of the indicator fads or method fads. I mean, it's so funny because they will try to sell you something and then they will include all these other things. Well, if the thing they're selling you is so good, why are they including all the other things? If you just do some examination and ask a couple of questions, pointed questions, you'll see that these guys are just marketing. We've talked about it before. All they're trying to do is get your attention so they can work on you and convince you to separate yourself from some of your hard earned money. And the thing is, that's part of money management, is not giving your money away to people who are just going to try and sell you something that you don't need. Really, you just don't need it. For example, I mean, something really simple here is just drawing that yearly open line. You can see price tried to make it back and then it got pushed right back down through the wick zones, out of the wick zones, which are just horizontal lines drawn from the previous day. I mean, you don't even need an indicator to do it. You could plot these on a daily basis. You put it on there, and then every day when you go to your chart, you can just go ahead and move those lines for the pair. Of course, indicators make it easier, but it's just nonsensical to believe that something squiggly is going to tell you something more. I mean, price is going up and down, right? So here for the week, you see we were in that upper wick zone. We came out of the upper wick zone. We're about to go into the lower wick zone, 5 pips off the bottom. And we got that gap to fill. In fact, we got all the gaps to fill. Now you see, there's something that you get. I show you week after week after week how these gaps fill. I mean, we had, I think, our worst week all of last year. There were 4 unfilled gaps, but that doesn't mean the trade couldn't have been profitable. So, once again, something so simple as just seeing where price is in relation, from the weekly open to the previous week's close and watching that area fill. And this year, we've been talking about open ranges. So the first day of the month will have an open range. The first day of the week will have an open range. And you see we can drill down here. This was the Monday range. You see here we popped out the very next day, which is today, and we came back in and we popped out, back in and back out again. So basically we're trading wick zone exits here, but something so simple. Once again showing we didn't quite make it back to the open of the first trading day here of the month. And you see we're about ready to exit the first trading day of the month I'm sorry, of the year and of the months low. And we went into that inside bar and we exited that inside bar. Inside bar happened 3 days ago, and you see here, once again, it proved to be profitable. Once again, a pair of horizontal lines. When the price gets in between those horizontal lines, you just take it whichever way it's exiting. I mean, you can't break it down any simpler than that. That's price action. It's either ranging between two areas or it's not. It's either making a new high or a new low or it's not. Now let's see, do we have any new candidates here? Oh yeah, looks like the New Zealand pairs all put up inside bars yesterday. And there was an exit. That would have been profitable. It's going to take some time to load that. There's an exit that would have been profitable. And you see here, that was also a weekly inside bar. These New Zealand pairs, and there was an exit that would have probably been a scratch or just a couple pips, and there was a nice profit there. A couple handful of pips. Euro CAD. It takes a while to load up because I usually don't look at these pairs. And you can see here we had an inside bar break of the daily, which happened 1 day ago. We've got an inside bar break of the monthly, which happened 6 months ago. And now we're inside the weekly inside bar that occurred 5 weeks ago. So once again, those can be profitable. Range 127 here. We've got a whole bunch over 200. In fact, 1, 2, 3, 4, 5 pairs over 200 pips, all of them being pound pairs. And you can see here, close low. These pairs are all near the low. You can see off of that open, how far they moved. Lots of pips to be made off of that buy zone or daily open cross. And the weekly holos, here we've got the lowest open, H1 lowest open for the week, just put in. So look maybe to go north. Buy zone, you see we had a pivot that was missed, pivot got taken out, and you can see here the pivot was between the zones, so once again no bias, but we were looking to close that missed pivot, which it did. And we'll see that in a second on the other chart. And the rat zone traders, you can see here we're putting in a new low. Look for it to reverse with the rat reversal. Now, one of the things about the rat zone trader that traders have to realize, I mentioned this many times, you need a range, okay? And the range needs to be at least 40 or more. Otherwise, at 40, the zones are right next to each other. So I like to see a range of about 60 or more before I really look for rat reversals. And over, where us Forex pirates congregate and talk in a forum, we've been discussing this rat zone for years. I don't know, has it been a decade? I can't remember when we first started talking about the rat zone. But you have to let price range so it can come back. So if you try and do rat zones here in the first 3 hours, the Asian or the New Zealand, Australian session or early Asian session, there's just not enough range. Rule of thumb is you want to wait I'd say for about 60 pips or more, and depending on what the frequency distribution of the range is. Because really, you want it to be extreme. So let's say the frequency distribution says it's usually between 70 and 80. But there's also maybe 5–10% of the time it ranges 100 or more. Well, in those ranges of 100 and more, that's when you want to really look to start trading the rat zone for those reversals, because it's going to get those wick zones are probably going to be 20 pips or more, and that's when those wick zones could probably maybe exceed those 20 pips or more. So that's, you really, well, it's going to exceed the 20 pips, or might hit 40, 50, 60, because it really can't exceed 20 pips or more. I guess it's not really that early, but I guess I'm just not awake yet. Because the or more means it's more than 20. So we have our pivot lines here. You can see right here that central pivot zone, how we took it out. And you can see there's that missed pivot of 123.31. That price is looking like it wants to fill. And we still have these two pivots from last year that haven't been filled. And okay, that's on the dollar yen, but price action, you can see 3-ball red at the line. What happened? But we need to put this back to the euro yen, and you can see we have a 3-ball here. So Larry live trade going long at 23.70. Had a 3-ball here, red at the line, red at the line, red at the line, profit. Wick zone, in and out, lower, in and out, low and out, in and out again. Okay, you can see here my favorite trading, or one of my favorite trading screens. Once again, just trading at the line. And you can see not much movement, just up and down in about 4-pip range. The Einstein line, you can see here there was a pop. It popped out, came out more, started to come back. That should be an indication here. Even on M1, you can see it's not making that new high. So just scratch that trade here on the low. There was pips to be made, didn't make a new low, came back out of that wick zone. See, even on 1 minute, you can use the same price action, the same work to pinpoint your exits and take some profit. Of course, it could have gone back here, reversed, and gone further. But, that's just trading. Sometimes you take a little, sometimes you take a lot. So, fellow traders, that kind of wraps it up for today. Just remember these indicator fads. I'm sure your inbox is probably almost as full as mine with these latest indicator fads. Just ignore them. Put a couple horizontal lines on your chart and just trade in the direction price crosses them. That's all you have to do. Just remember, it's not what you trade, it's how you trade it. So let's get out there and drain the banks this week.